For more on the big move in the market, let's bring in Jonathan Krinsky, BTIG's chief market technician, because he's zeroing in today for all of you on the NASDAQ. You suggest the NASDAQ 100, the Qs, have gone 198 trading days without a 2.5% or worse daily decline. That was your note from earlier today. Prescient, given what we're witnessing here. What are you watching for now?
Yeah, I mean, it's pretty remarkable. The last time we went a full calendar year without a 2.5% or worse daily decline on the NASDAQ was 2013. And if you think about that period, the NASDAQ composite had pretty much 70% of stocks above the 200-day for the bulk of the year. This year, we barely have had any days above 50%. So, 2013 was a classic low volatility environment. You would expect that. You would not expect it this year. And I think it just goes to show, again, it's another way of showing how dominant a handful of stocks have been. And as you and Mike were discussing earlier, it really has not been a good year for stocks in general. I think the headline indices, S&P up 12%, NASDAQ up 35% or so. It really just is in a completely different ballpark from the median stock, which most institutional investors, that's really what they're owning. So ultimately, we think that this 4,200 level in the S&P 500 with the 200-day moving average is a very consensus call that will hold. And we think the fourth quarter rally is a very consensus call. So ultimately, we're not so sure it's going to be that easy. And we think we're at the point now where you're starting to see some of the winners, some of the high momentum stocks catch down to the laggards. And I think that's ultimately what drives the NASDAQ lower here.
Read at least one note today, speaking of NASDAQ, that the risk to the negative market call is that there is a late year dash for performance, and it goes right into the 7 stocks that have proven to be tried and true, a little bit of defensive, you have better balance sheets, all the cash, not relying on debt, et cetera.
Yeah, look, I think that's why they're up so much, and that's the crowding risk, right? And so I think we're getting a little ahead of ourselves talking about the year-end rally until we see, where things shake out as we get through October. And we don't know that, right? If we get a bigger washout in the top 7 stocks, then sure, maybe that's the case. But based on our work, there's still a lot of downside for these names, and you're seeing the unwinding effect. Some of the worst performing stocks on the year, a name like Dollar General is actually up 2% today. So you're seeing some of those laggards being bought and some of the winners being sold. And I think we're still a bit early to flip the script there.
Man, I'm looking at some of these losses today out of the discretionary space, which obviously gets, overmoved, if you will, by an Amazon or a Tesla, for example. But the losses today in some of the restaurant stocks, Domino's down more than 4%. The cruise lines are getting absolutely hammered. Carnival's down near 7%. Mortgage rates, we're talking about yields going up relentlessly. Mortgage rates continue to do that too. 7.7 on a mortgage rate. It's stunning to see these numbers because people are just not used to the levels being where they are. Home builders today, Pulte Group down 3%. Depot and Lowe's. How at risk do you think is the discretionary space in general for a consumer that's held in there better than most ever expected it would?
Well, the consumer space is something we talked about several weeks ago when crude oil and gasoline were breaking out, and there was a lot of consumer and restaurant stocks were in weak technical positions, and we thought the spike higher in energy prices was another headwind there. So, look, the trend in most of those names are certainly weak and continue to be weak. I think the only areas that we're suggesting maybe you can see a bounce on are the extremely washed out names, like I mentioned, like a Dollar General. But there's still, it's not going to be an easy path, right? I mean, we're talking about trends that are severely damaged, and you can get bounces there, but it's going to take a lot to reverse those downtrends.
How about energy? Give me a thought on that before I let you bounce. You've got another, a green day for crude, Brent, WTI as well. We're basically at $90.
Yeah, look, I think if outside of some of the extremely beaten down areas, if we have to be anywhere, we'll probably stick with the energy trade. I think at some point it does come to the unwind factor, right? I mean, at some point even the best stocks get unwound. So if this sell-off intensifies for the next couple of days, I think even energy would be at risk. But the trends there are still pretty good. So I think it's more of a tactical pullback.